In 3 hours, Shanghai opens, and I'm watching silver traders make the exact same mistake right now that completely destroyed accounts on March 22nd. My name is John, this is The Hidden John, and it's Sunday, April 12th, 2026 at 9 p.m. Eastern Time. What I'm about to tell you in the next few minutes could save you from financial ruin or help you avoid the single biggest trap that's about to snap shut when Asian markets start trading. This is not theory. This is based on actual trading data from the March 23rd crash that I've spent weeks analyzing. The pattern is repeating itself right now in real time. Let me start by showing you the mistake, and then I'll explain exactly why it's so deadly and how to avoid it. Right now, at this very moment, there are thousands of retail traders sitting in front of their screens waiting for Shanghai to open at midnight Eastern. They're holding long positions in COMEX silver futures, or call options that they entered on Friday or earlier last week. They watched a silver rally from $67.75 on March 26th to $77.31 on April 8th, and they're convinced this is the beginning of a major breakout toward $100. They heard about the Islamabad talks failure, but they're telling themselves it's already priced in, or physical demand from Asia will support the price, or the technical setup is too bullish to fail. Here's the mistake. They're planning to hold their positions through the Shanghai Open to see what happens before deciding whether to exit. They're thinking, if Shanghai opens weak, I'll just get out then. How bad could it be? The answer is catastrophically bad. Let me show you exactly what happened on March 22nd to 23rd to traders who made this exact same mistake. On March 22nd at 4 p.m. Eastern, COMEX silver closed at $84.20. It was a Friday, just like April 11th was a Friday. Over that weekend, there were rumors of ceasefire talks stalling, similar to how we just had the Islamabad failure this weekend. Some traders sold on Friday anticipating trouble, but many held, thinking they'd wait and see what Asia did. Shanghai opened Sunday night, March 22nd at 11:30 p.m. Eastern, which was Monday morning in China. In the first 5 minutes of trading, Shanghai silver dropped from 685 yuan per kilogram to 671 yuan, which was about a 1:80 drop in dollar terms. Not terrible. Some traders saw that and thought, okay, it's weak, but not a disaster. I'll hold and see if it bounces. It didn't bounce. Over the next hour, Shanghai fell to 652 yuan, then 638 yuan, then 619 yuan. By 2 a.m. Eastern, when Tokyo opened, silver was down $7 from the previous Friday's close. By 3:30 a.m., when London opened, it was down $11. By 8:30 a.m., when New York opened, it was down $19. Here's the critical part. Traders who decided to wait and see at the Shanghai Open found themselves unable to exit their positions at reasonable prices because of a phenomenon called slippage. When markets are falling fast on heavy volume, the bid-ask spread widens dramatically. On a normal day, the spread on a COMEX silver futures contract might be 1 to 2 cents. On March 23rd, during the panic, spreads widened to 30 to 50 cents at times. What that means is if you wanted to sell at what the screen showed as $72.50, your actual fill might be $72 or $71 or $80. You're losing an additional 50 to 70 cents per ounce just from slippage on top of the underlying price decline. But it gets worse. Many retail traders use stop-loss orders to protect themselves, and that's smart in normal conditions. But during extreme volatility, stop-loss orders become market orders once they're triggered, which means you get filled at whatever the next available bid is. On March 23rd, I reviewed trade data and found instances where stop-loss orders placed at $75 got filled at $73.20. That's $1.80 of slippage on a single order, because the market was gapping down so fast that there were no bids between $75 and $73.20. Your stop got triggered at $75, but by the time your sell order hit the market as a market order, the price had already gapped through multiple price levels with zero liquidity. Now, if you're trading 1 or 2 contracts, that slippage costs you $1,800 to $2,000. Painful, but survivable. But if you're trading with leverage, if you're holding 10 or 20 contracts on margin, that slippage can trigger a margin call. Your account equity falls below the required maintenance margin, and your broker forcibly liquidates your entire position at the worst possible prices. I personally know of traders who went into March 23rd with $80,000 accounts holding 15 COMEX silver contracts. By the end of that Monday, their accounts were worth $12,000. They lost $68,000 in one day, and a significant portion of that loss was not from the underlying price move, but from slippage and forced liquidation during the panic. So here's the mistake in crystal clear terms. Holding leveraged long positions through a weekend when major negative news has occurred, planning to wait and see what Asia does, and hoping you'll be able to exit cleanly if things go wrong. That's the mistake. And it's a mistake because when things go wrong in silver, they go wrong faster and more violently than almost any other market. Silver's average true range, which measures daily volatility, is currently running at $3.20 per day. But during panic events, we've seen moves of $10 to $15 in a single session. You cannot react fast enough to protect yourself once the cascade starts. Now let me show you why this weekend specifically is high risk for a repeat of the March 23rd scenario. We have 5 factors that are nearly identical to the setup before March 23rd. First, a major geopolitical catalyst occurred over the weekend. In March, it was ceasefire talk stalling. This weekend, it's the complete failure of the Islamabad summit with Iran refusing to give up nuclear weapons. Second, the failure happened on a weekend when markets were closed, meaning it hasn't been priced into Western markets yet. Third, the ceasefire is temporary and close to expiring. In March, there was uncertainty about whether fighting would resume. Now, we have 10 days until the current ceasefire expires on April 22nd, with no framework to extend it. Fourth, there's a military flashpoint developing in real time. In March, it was Iran's initial closure of the Strait of Hormuz. Now it's 4 U.S. Navy destroyers conducting mine-clearing operations in the strait, while Iran threatens to attack them. Fifth, technical indicators are showing similar weakness patterns. In March, we had declining volume and RSI divergence before the crash. Right now, we have the exact same signals on the daily chart. The setup is eerily similar, and that should terrify anyone holding leveraged longs going into tonight's Shanghai Open. But here's the part that makes it even more dangerous this time, the options market. On March 22nd, total open interest in COMEX silver options was about 185,000 contracts. Right now, as of Friday's close, total open interest is 291,460 contracts. That's 57% higher. There are significantly more options positions outstanding today than there were before the March 23rd crash. And here's why that matters. When the underlying futures price moves sharply, options delta changes, which forces market makers to adjust their hedges. If silver crashes $5 or $8 overnight, the delta on call options collapses, and market makers who are long futures as a hedge against their short calls have to sell those futures. That creates additional mechanical selling pressure on top of the fundamental selling. Let me give you specific numbers. There are currently 18,450 call option contracts at the $80 strike expiring this Friday, April 17th. At Friday's close, with silver at $75.33, those calls had a delta of approximately 0.28. That means market makers hedging those calls were long about 5,166 futures contracts, or 25.8 million ounces. If silver falls to $70 by Monday afternoon, the delta on those $80 calls drops to maybe 0.08. Market makers only need to hold 1,476 futures contracts as a hedge, which means they have to sell 3,690 contracts, or 18.45 million ounces. That's forced selling that has nothing to do with fundamentals and everything to do with options math. And that's just one strike price. When you add up all the out-of-the-money calls across all strike prices and expiration dates, there's potentially 40 to 50 million ounces of futures selling that could hit the market if silver falls sharply. That selling accelerates the decline, which triggers more stop-loss orders, which causes more delta hedging adjustments, which accelerates the decline further. It's a feedback loop, and it's exactly what happened on March 23rd. Now let me show you the second mistake that traders make, which is even more subtle and dangerous. This is the mistake of trying to buy the dip during a panic. On March 23rd, when silver fell from $84 to $78 in the Asian session, a lot of traders saw that as a buying opportunity. It's down 7%. That's oversold. I'm buying here, they thought. Silver continued to fall. At $75, more traders bought. Now it's really oversold. This has to bounce, they thought. It didn't bounce. It fell to $70, then $65, then $61, $76. Every single trader who tried to catch the falling knife on the way down got crushed. Here's why buying the dip is a mistake during a genuine panic. You have no way of knowing where the bottom is until after the fact. On March 23rd, the low was 61.76, and it happened at 9:47 a.m. Eastern. But at 7 a.m. when silver was at $75, or at 8 a.m. when it was at $70, or at 9 a.m. when it was at $65, there was no way to know it was going to $61.76. If you bought at $75 thinking you were getting a bargain, you were down $13.24 per ounce by the time the low hit 2.5 hours later. On a leveraged position, that's a 17.6% loss that could have wiped out your entire margin. The correct strategy during a panic is to do nothing. You don't try to catch the knife, you don't try to pick the bottom. You wait for the panic to exhaust itself, for the market to find a floor, and for some semblance of stability to return. Only then do you consider entering. On March 23rd, the low was $61.76 at 9:47 a.m., but you couldn't have bought at $61.76 because you didn't know that was the low. The safe entry point was around 2 p.m. that afternoon, when silver had bounced back to $68 and held that level for 2 hours. At that point, you had confirmation that the panic was over, and you could buy at $68 with reasonable confidence that you weren't going to get stopped out at $60 an hour later. Yes, you missed the absolute low. You didn't buy at $61.76, but you also didn't get steamrolled trying to catch the falling knife. You bought at $68 with a clear stop at $66, risking $2 per ounce, and you rode it back up to $77 over the next 2 weeks for a $9 gain. That's a 4.5 to 1 reward to risk ratio. Compare that to the trader who bought at $75 during the panic, got stopped out at $70, rebought at $68, got stopped out at $64, and finally capitulated at $62 for a total loss of $13 per ounce. Same market, different strategies, completely different outcomes. Let me now give you the third mistake, which is specific to physical silver buyers. I've seen a lot of comments and messages from people saying they're planning to wait for Monday's open. And if silver crashes to $70 or $68, they're going to buy physical silver from dealers at those bargain prices. So this sounds logical, but it's based on a fundamental misunderstanding of how the physical silver market works during panics. When the COMEX spot price crashes, dealers don't immediately lower their prices. In fact, premiums often increase during panics, which means you might not save any money at all. Let me show you the data. On March 23rd, when COMEX spot hit $61.76, I checked dealer prices in real time. APMEX was selling American Silver Eagles for $79.99. That's an 18.23 premium, or 29.5% over spot. JM Bullion was at $77.50 and 15.74 premium, or 25.5% over spot. SD Bullion was at $76.95 and 15.19 premium. Why were premiums so high when spot was crashing? Because dealers know that panic-driven spot price drops don't reflect true physical supply and demand. They know that if they lower prices to match spot, they'll be flooded with buy orders, and they'll run out of inventory. So they keep prices elevated to ration supply. Here's the brutal truth. If COMEX crashes to $68 on Monday, you might find that American Silver Eagles are still selling for $82 to $85 from major dealers. Yes, spot is down $7, but premiums are up $8, so your actual cost is unchanged or even higher. The only way to buy physical silver at true crash prices is if you have a pre-existing relationship with a dealer who will honor spot plus standard premium pricing, or if you're buying in large enough quantities to negotiate directly with a wholesaler. For the average retail buyer clicking a buy on a dealer website, you're paying the premium the dealer sets, and that premium often moves inverse to spot during volatility. Now, let me give you the correct strategy for handling tonight's Shanghai Open and tomorrow's New York Open if you currently have positions. If you're long silver with leverage, futures, or options, and you're showing a profit, close the position before midnight Eastern tonight. Take your profit. Don't try to squeeze the last dollar out of the trade. The risk reward is terrible right now. The most you can realistically make if everything goes perfectly is maybe $3 to $5 per ounce if we break out above $77, $73. But the amount you can lose if things go wrong is $10 to $15 per ounce or more. That's a 1 to 3 risk-reward ratio at best. You should never take a trade with that kind of asymmetry unless you have strong conviction. And right now, the weight of evidence leans bearish, not bullish. If you're long silver with leverage and you're currently underwater, showing a loss, you have a harder decision. You can either cut the loss now before Asia opens, or you can hold and hope Asia is strong. If you choose to hold, set an absolute pain threshold, a price level where you exit no matter what, and stick to it. For example, if you're long at $76 and currently down 0.85 with silver at 75.15 on Globex, you might say, I'll hold through Shanghai, but if it drops to $74, I'm out with a $2 loss. That's your line in the sand. Don't move it. Don't rationalize. If it hits $74, you exit, period. Because if you don't, and it drops to $70, you're down $6, and now you're in psychological denial mode, holding and praying for a miracle. If you own physical silver, do nothing. Don't panic, sell. The spot price gyrations are irrelevant to physical holders. You bought physical silver for long-term wealth preservation, and the fundamentals supporting that thesis have not changed. 6 consecutive years of deficits, industrial demand growing at 8% to 10% annually, China restricting exports, COMEX inventories draining. All of that is still true on Monday morning. The paper price might crash to $65, but that doesn't mean your physical metal is suddenly worthless. It means the paper market is panicking while the physical market is calmly accumulating. Hold your metal. If you have cash on the sidelines and you're looking to buy, my recommendation is to wait. Don't try to buy tonight or Monday morning during the initial volatility. Let the market show you where it wants to stabilize. If we crash to $70 and bounce back to $72 within a few hours, that $72 level is your signal that the panic is over. That's when you buy. But if we crash to $70 and just keep grinding lower to $68, then $66.6, then $64, you wait. You let it find the floor first. Yes, you might miss the absolute low, but you also won't get caught in a falling knife that takes your hand off. Here's the specific timeline and levels I'm watching. Shanghai opens at midnight Eastern, 3 hours from now. If Shanghai opens below 610 yuan per kilogram, which is about $82.70 per ounce, that's a weak open, and I'm expecting further selling. If it opens above 620 yuan, which is about $84.10, that's a strong open and suggests physical demand is supporting prices. Tokyo opens at 2 a.m. Eastern. If Tokyo confirms Shanghai's direction, meaning if both are weak or both are strong, that's a higher conviction signal. If they diverge, with one strong and one weak, that's confusion, and I stay on the sidelines. London opens at 3:30 a.m. Eastern. London is critical because it's the largest physical market, and the LBMA spot price often leads COMEX. If London breaks below $74 on strong volume, I'm expecting New York to gap down below $73.50 when it opens at 8:30 a.m. If London holds above $75, I'm expecting New York to open flat to slightly higher. New York opens at 8:30 a.m., and the first 30 minutes are everything. If we gap down and immediately bounce, that's short-term bullish. If we gap down and continue falling, that's confirming the breakdown, and I'm waiting for $70 or lower to even think about buying. This is the Hidden John. It's 9 p.m. on Sunday, April 12th, 2026. In 3 hours, Shanghai opens, and the mistake that destroyed accounts on March 23rd is about to repeat itself if traders don't learn from history. Don't hold leveraged longs hoping to see what happens. Don't try to catch a falling knife if panic selling begins. Don't expect physical dealers to give you bargain prices just because spot is crashing. The only way to survive what might be coming is to have a plan. Stick to your rules and be willing to accept small losses to avoid catastrophic ones. I'll be posting live updates on the community tab through the Asian and European sessions. Stay disciplined out there, and whatever you do, don't make the March 23rd mistake again.